Folks, we are talking with the man, myth, the legend, somebody that is housing, housing, housing. We are talking to the one and only Lance Lambert. How you doing, sir?
Doing good. Housing, housing, housing. Always a lot going on.
Yeah, we haven't talked since we got the what I'll call surprising, shocking jump in existing home sales for the month of February. I believe they went from 4 million to 4.58, a 14.5% jump. Did that shock you? Did you expect such a blowout number?
I think I looking at the numbers, I think existing probably the jump or even the decline before. I think as we get more in, I think we'll see the story a little more clearly. But I believe what's happened is that existing has hit a bottom essentially, and has maybe rebounded a bit, but it's constrained by supply. So it doesn't, you know, there's only so much you could go up, right?
Yeah.
There's not
Yeah,
a,
so let's
things
be
are down 20% year over year. And so it was able to eat up some of the inventory that was on the market. And we've seen inventory go down, but you can only eat up so much of the inventory on the market with new listings being down so low. So existing is constrained, but existing has also started to see another C word pop in: constrained and competitive.
Oh,
Uh,
yes. Yes.
Constrained, it's constrained. It can only grow so much with supply being like this, especially once it eats up the inventory on the market. But as it does, it only gets more competitive if things don't begin to shift the other way. So that's the new home side. I think, or the existing side, I think the new home side is probably rebounded a little more than has been
Mhm.
suggested in the numbers. So
I agree.
existing got the blowout and new was kind of not quite up as
Muted.
much.
Yeah.
So I think it'll be interesting to see the next few. I would expect, at least the narrative, and based on looking at some of the other metrics, I would think that new would rebound a little more than existing here and
Oh,
has
I
more
agree.
potential to rebound too.
Yeah, they have something that the market desperately needs, the ability to throttle supply. It's kind of that simple on the new side. A couple of things I want to highlight that I brought up the day after the pending home sales came out. I think it was 2 or 3 weeks ago. Was I expect the March home sales, existing home sales, to be down from last month, which a lot of people don't understand. Michael, you don't understand. In January we did 4 million. We just did 4.5. I'm like, guys, you can't sell the home twice. November and December were slow. I talk to people every day. That inventory got chewed up the first, second week, third week of January. Those were your February closings. And new listings are coming. We're down 20%. We're still falling. This is the spring selling season. Inventory's not coming. We are not doing 4.5 million existing home sales in the month of March. That is my personal call, not yours. It just doesn't mathematically look possible to me.
Yeah, so I think it'll be interesting to kind of see what happens with it. I think a few things. There could still be some pullover from the early part of the year where it's eating up that inventory.
Sure.
Uh, the other thing is it could be that the bottom was overstated, right? The
Mm,
drop. And so
could
maybe
be.
the uptick wasn't, or it could be that the 4.5 was overstated. These numbers have a fairly big margin of
Mm,
error.
yeah.
Uh, I don't never read too much into 1 month, although trajectory changes you kind of do, especially
Yeah.
if the other macro data is kind of telling you it is.
Yeah.
So it'd be interesting to see where that kind of lands. And it's interesting to also see how the market reacts to these mortgage rates, which have come down a bit. And depending on your credit profile, you can get even a little better. And if you're savvy and, getting quotes,
Yeah.
there's lower rates to be had for some people.
Yeah. So I'll even be more explicit. I think what February proved for us is that interest rates matter. I think that's the net effect, right? If you look at the closings in February, that was January business. Rates were generally falling. Let's be very clear with everybody watching. We've seen rates precipitously fall in the last week or two since Silicon Valley Bank. They're now in the low sixes as an average. Uh, like yourself, who comes on every week. I have mortgage brokers that come on every week. They're telling me that good credit, meaning 760 and above, full doc, owner ox, are getting stuff no points with a 5 on it. I
Mm,
just had a conversation again, owner ox, 20% down, 780 credit score. They got something with a 4 on it, paying 2 points.
wow.
A 4 with 2 points. Rates matter. That's what I learned from February. And again, rates matter on the supply side. Fortune has done a lot of great articles recently about interest rate lock-in, which I was a part of 3 weeks ago. You have followed it up. Your writer, author. What's that? What's the right word?
Yeah, real estate writer.
Real estate writer has written up. Please give her a shout out. Her name escapes me, but she's followed up week after week with great people being locked in. Some people frustrated. They feel trapped. Others feel like it's a good thing and it's an asset. Um, but the key to that is the supply. It's not coming. I don't care if you're frustrated or you feel lucky. You're not listing. And that's going to be a problem for years to come.
Yeah, it's a very constrained market with that move up segment just kind of, frozen. And, of course, where that moves into the market with supply is that, if you don't want to move up, a lot of times, you're giving up something maybe on the lower end and moving up to the higher end. So it's pulling away some of the demand, maybe more from middle top,
Yep.
and pulling supply away from the bottom. I think as rates move down over time, you start to see more of that come in, but with it comes demand. It's not so. That's the
Not
interesting.
1-to-1 ratio. It's not one
Yeah,
to one.
the part of this was not a very intuitive. It wasn't intuitive how the correction worked, which is the time where new listings are going down the fastest is the time that prices are moving down the quickest. And then over time, as new listings move up, hopefully it moves up over time. We're probably going to be in a more normalized appreciation market. So the two don't necessarily go hand in hand together, and that the part that gave the correction in some of these markets is when affordability was at its most pressurized
Of
time.
course.
When and there was not a lot on the market and there was not a lot happening, but the most pressurized point was when you got some of the price corrections. And the issue for the people who want more price corrections is that during that period last year, which is the first time since 2014 that inventory on a year-over-year basis was moving up.
Mm-hmm.
That inventory that built up, which wasn't a lot, has quickly been drained down in a lot of these markets. And so that was the runway for the correction, and a lot of it's gone. And so that'd be interesting to watch, and especially to see what type of appreciation we can get in the spring. But it's also interesting to see how some of these markets are bifurcating within the bifurcated housing market. So an interesting one is who's the appraiser in Sacramento on Twitter?
Um,
He's great. He's
yeah,
great.
he's awesome.
Always
I'll
on.
find it. I'll
Yes.
find it.
The stuff he's been saying about Sacramento is just super interesting.
Ryan Lundquist. Ryan
Yes, how
Lundquist.
competitive the market's gotten there. And, Sacramento is a market that did see a correction last year.
Mhm.
Black Knight still has them down through February from peak like 9%. Zillow, if you look at the middle of the market, it's like 6. But they're getting way more competitive now. But if
Yeah,
you look for inventory, it's gone way down. The inventory's gone
way
way.
down, way down.
But then you look at Austin. Austin has gone down some, but not a lot. And
Not a
and
lot.
actually,
Yeah.
it's one of the few markets that moved up in March. So I think there's still these markets that are vulnerable out there to correction in the second half as we move out of the stronger seasonal period. And Austin in these metrics is still dropping. Maybe that'll change in the spring. Maybe it gets some appreciation. But I still think some of these markets are vulnerable, but they have to have some supply.
Yeah.
And so I think the markets like the Sacramentos, the way they got some declines is there was already a structural shortage of homes there, right?
Correct.
And so people were already so overextending themselves for homes that when you threw in that mortgage rate shock, it pushed the affordability to just
Astronomically. Yeah.
astronomical levels. So there had to be some let up in the market.
Agreed.
And during that period, you got a little bit of supply, but now it's drained out and it's getting competitive. People have accepted the market. There's been an acceptance, and the little bit of drop in mortgage rates, a little bit of price drops here have just kind of helped it to meet the market. I don't quite know if Austin's in that place because Austin could be having an effect where the migration cycle in the country may have rolled over more.
Maybe. Yep.
And they have a lot of new home construction. It's not Sacramento. There's a lot of building going on, a lot of sprawl. And so it'd be interesting to kind of see how this plays out. But boy, do you have to know your market and not just look at the headlines of even people like me that I put out. There's just so much variation throughout the country right now. And there was through the boom too, and there always is. But and within price tier and within home type and within geography, exurbs, still a lot of people moving into them. So it's a complex market and a lot going on.
Yeah. Again, as I talk about, you probably heard me say, you got to know your buy box, better than anybody else. Guys like you and I look nationally because it's fun. It's entertaining. I've been doing it for 20 some odd years. But yeah, if you're an investor or a home buyer, please get your buy box, your area, learn your little slice of the world better than anybody else, because it's probably acting different than the nation, which it always does, to your point. Last kind of point on this, again, my theory in video number 2 is interest rates matter. I think it's generally believed that interest rates are kind of on a slow downward trek for the rest of the year, right? We're not going to be talking 7, 8, 9% mortgage rates. I think that's long gone. Where I'm going with this is one of my 12 crazy real estate calls from January 3rd was John Burns Real Estate Consulting would change their ultra bearish bet on housing, which I seem to recall was negative 20% or negative 10. It was a double digit number. Has John Burns changed it? Because you're everything housing.
No, I don't know if they've changed it. I also don't know what metric theirs was on, which I've raised
Oh,
before.
that's true.
I'm not quite sure. I've done a better job with recent ones with making sure I know which index they're talking about.
I think it was their specific index to
I don't know if it was Burns or I don't,
okay.
or if it was, and it could have been also their one with new construction. So I'm not sure.
Oh, that's a good point.
We've seen some come back down, but then like Goldman today put out a new one that still had 6 for the year, and so
6 negative or 6 positive?
year, for the
negative
down, yeah.
These housing analysts most of them got ultra bearish. As rates come down, you can expect some revisions, is my wild ass guess.
But then also, a lot of the housing types, let's take the Mortgage Bankers Association, which is their view has been this is the downward slope of the year. But then also last year, they didn't think mortgage rates were going to move up too much more. Goldman was thinking rates would move up more. And then this year, they still think, let me just pull up their latest number and see where they are. But there's still a divide on the trajectory of rates for the year.
I think Goldman was high, if I remember right. 6.5, they were calling it as an average.
Yeah, they still are. I think
6.5. Yeah.
But there's also this view of once the Fed has essentially done rate hiking, there is this view by some that the 10-year will move up. It's not like a lot of the real estate housing are like, oh, once the Fed is done with the rate hiking cycle, it's down the rest of the way. But there's this view growing on by some of these Wall Street firms that once they have actually paused, that the 10-year could move up. I don't know what their reasoning is, and I'm still trying to track that one down.
Yeah, I'm going to poke at that. I had not thought of that. Okay.
And so, I've seen Bill McBride touch on it before.
I like Bill.
I don't know. I just don't know why that would be. Intuitively, it would make more sense that as we kind of know where the rate hiking cycle goes, and if the economy weakens more and inflation comes in more, the expectations for short-term rates for the future and rate hikes or and actual cuts to the
Cuts, right? Cuts. Yeah.
factored into the long-term curve that we move down, right?
Yeah,
That's
you know what I would love is just the margin to come in. It is sitting at now. Yesterday was, it came in a bunch yesterday, but the margin between the 10-year and 30 years, again, 2 or 3 standard deviations above normal.
and so what can roll that over? That has not really moved much at all since the
Yeah,
rate cycle.
the only thing that rolls
Does
that over in
the
my
Fed
opinion,
start buying MBS?
no. Well, I mean that would obviously do it. To me, they just have to say I'm done raising.
I don't
I think,
know. That,
yeah,
see,
we'll
that's
see.
something that there's that view, but then there's also maybe they broken the MBS market.
Maybe,
Uh,
maybe
uh,
that's
but
true.
I don't know enough. I don't know.
We're going to
Let,
know May 3rd. May 3rd is the last time they raised 25 basis points. They're going to say they're going to kick back, relax. We'll know. We'll see if rates come. We'll see if the margin compresses after May 3rd.
okay, so this is interesting. So here's the new report out from Goldman Sachs.
Okay.
They had the 10-year averaging 3.7 in the first quarter and 6.2 on the 30-year.
Okay.
The second quarter, they have 4.1 for the 10-year,
Ooh,
and they have
that's
6.5 for the 30.
both of those are not looking good currently.
Okay, now here's Q3.
Oh no.
4.3, they've raised it for the 10-year, and 6.3 for mortgage or 6.6 for mortgage rates. Then in Q4, 4.2 for the 10-year and 6.5. This is becoming a more popular view this later
Really?
part of the year. Yeah, it's there the housing types, the Mortgage Bankers Association, and I
Well,
forget
let's
some.
play this out. That's
Oh
basically a
no, I don't
full
know the
point.
space. I don't.
That's a
Why?
full point.
Why? Because why why are some thinking that we're going to continue to roll over through the year with mortgage rates as the Fed kind of backs off its rate hiking cycle, and then others are like, as they're done, we move up more, because both of these groups are probably not thinking the Fed is going to be at a different point. Like nobody, like right now, everybody's views on where the Fed's going are kind of condensing, right?
Yeah, I agree.
6 months ago,
5.25. Yeah.
yeah, 6 months ago, everybody's kind of a little more all over the place in terms of,
Right.
but
You're
as
right.
it's kind of moved, especially once Silicon Valley Bank failed, now everybody's like, okay, the 25, although some were starting to think pause, but 25, and then maybe one more 25, and the Fed is done
It's
for the
done.
year. And if jobs finally break, then later in the year, maybe there's some cuts. But then if
Yeah.
everybody has that view, why do some have the 10-year going lower and mortgage rates going lower, and then others higher a little bit?
Yeah.
Or
So, you know what, folks? Let's get audience participation here. Could you guys leave comments below for Lance and I? Why do you think Goldman Sachs, a well-respected firm and the best of the best, would think the 10-year note is a full 1 point higher than it is today? Because I think you're right. I think Goldman Sachs probably sees one more quarter. Maybe they see two more, but you're right. People are coalescing, getting closer and closer. So, folks, leave us a note below. Let us know why you think that might be, because I'm sitting here, I don't see it, but again, I'm a housing guy, so maybe I have a blind spot. So if you can highlight my blind spot, I would appreciate it. Lance, where can people follow you and find your work?
yeah, they can find me at News Lambert or Google Lance Lambert Fortune. And just one more time, the numbers from Goldman Sachs 10-year, they have it 3.7 Q1 for the 10-year, 4.1 for Q2, 4.3 for Q4, and 4.2 for
Four
Q4.
two.
And then rates, the 30-year fixed, 6.2 for Q1, 6.5 for Q2, 6.6 for Q3, and 6.5 for Q4. And then
I'll
for
take the under.
2024, here's the interesting one for 2024. 10-year 4, mortgage rate 6.2.
Interesting.
Yeah.
All right. All right. Now, how frequently does Goldman update this? Is this like a monthly thing for
Here's
them?
the thing about Goldman. At this point, they have like three different teams putting out three different numbers.
Oh,
Uh,
okay. So we get a new
I,
one next week for all we know.
so it's been tough tracking Goldman. I don't know if you saw the chart I put out recently. Their team that does global home price forecast, they had us. They think that nationally down 2.5% for
Oh,
U.S.
I
home,
did see that. I did see that.
and
Yeah.
that we would have a 5% peak to trough. Well, this team on this model thinks 6.1 just for this year decline
Hmm.
for the Case-Shiller. Although I don't think the other ones, I don't know if it said what index it was for, but there's several different models. And there is a reoccurring theme through housing that if you use a national model, you're going to have less home price declines in
Of
your
course.
total. And if you do a roll up version, which means you forecast for every market in the country and then roll it up nationally, you usually end up with a bigger decline.
Interesting.
And now
Okay.
it's not a huge gap, but I don't know. But Goldman has multiple numbers and they're never, and you know, sometimes they will have an author, the same author on multiple of these. So I don't
Oh,
even they don't specify the models enough. So
that's all
I
right.
have a little bit of beef with how Goldman does forecasting.
Well, this is why you're on my channel, because you are everything housing. You stay up to date at a level that I appreciate. You are a must follow. News Lambert on Twitter, guys. Send him a note. Tell him you appreciate being here every week. Take care and say hi to baby Leo for us. All right.
Will do. Thanks for having
Thank
me
you.
on.